Faculty of Commerce Bcom, CBCS, V semester examination, March-April 2025, Business Economics, Paper GE, Common Paper for all streams. Time, 3 hours max, marks 80. Code node G3111BL, Part A, 5 times 4, 20 marks, short answer type. Note, answer any 5 questions. 1. Macroeconomics. 3. Consumer surplus. 4. Average production. 5. Implicit cost. 6. Production function. 7. Opportunity function. 8. Cardinal utility. Part B, 5 to 12 equals 60 marks. Essay answer type. Note, answer all the questions. 9. A. Explain the importance and role of business economics. Or B. Explain about the law of diminishing marginal utility and its importance. 10. What is demand? Explain the factors affecting demand for a product. Or B. What is elasticity of demand? Explain the types of elasticity of demand. 11. Explain the law of supply and its exceptions. Or B. Explain the features of indifference curves with the help of suitable diagrams. 12a. Explain the economies and diseconomies of scale. Or B. Explain the law of variable proportion. 13a. Explain the short-run cost curves with suitable diagrams. Or B. Explain the uses and limitations of break-even analysis. Answers. Number 1. Macroeconomics meaning. Macroeconomics is the branch of economics that studies the economy as a whole. It deals with national income, employment, inflation, economic growth, and overall welfare. Points. 1. Study of aggregates. Focuses on total income, output, consumption, and investment. 2. National income. Measures and analyses the income of a country. 3. Economic growth. Explains long-term growth factors like capital and technology. 4. Employment issues. Studies unemployment and suggests remedies. 5. Price stability. Examines inflation and deflation problems. 6. Government policies. Analyses fiscal and monetary measures. 7. Business cycles. Explains booms, recessions, and depressions. 8. National welfare. Improves living standards of society. Conclusion. Macroeconomics helps in understanding the economy's functioning, guides policymakers, and ensures stable and balanced growth. 2. Demand function, meaning the demand function shows the relationship between the quantity demanded of a commodity and the factors affecting it like price, income, and tastes. Points. 1. Mathematical form QD equals FPY/TPR, where QD equals demand. 2. Price factor, inverse relation between price and demand. 3. Income factor, higher income increases demand for normal goods. 4. Tastes and preferences, demand depends on consumer choices. 5. Prices of related goods, substitutes and complements influence demand. 6. Future expectations, anticipated price changes affect demand. 7. Other factors, climate, population, and government policies matter. 8. Graphical view, demand curve represents the demand function. Conclusion. The demand function is vital to understand consumer behavior and helps producers in planning production and pricing policies. 3. Consumer surplus, meaning consumer surplus is the difference between what a consumer is willing to pay for a good and what he actually pays in the market. Points. 1. Willingness to pay. Consumer may value a product more than its price. 2. Market price. Actual price is usually less than willingness to pay. 3. Extra benefit. The gap becomes the consumer's surplus. 4. Utility concept derived from marginal utility theory. 5. Individual surplus. Surplus enjoyed by a single consumer. 6. Total surplus. Combined benefit of all consumers in a market. 7. Graphical explanation. Area under demand curve and above price line. 8. Importance. Measures welfare and satisfaction of consumers. Conclusion. Consumer surplus reflects the hidden gain enjoyed by consumers and helps in welfare economics and policy decisions. Number 4. Average production meaning. Average production refers to the total output produced divided by the number of units of a variable factor, usually labor. Points. 1. Formula. AP equals TPL, where TP equals total product, L equals labor units. 2. Measure of productivity. Shows efficiency of variable factors. 3. Short-run concept. Used when some factors remain fixed. 4. Relation with marginal product. AP rises when MP is higher. 5. Stages of production. Increases, reaches maximum, then declines. 6. Helps in decisions. Assists managers in factor employment. 7. Graphical curve. AP curve has a hill-shaped pattern. 8. Economic indicator. Useful in comparing efficiency across industries. Conclusion. Average production highlights the efficiency of inputs, guiding firms to use resources effectively for maximum output. Number 5. Implicit cost meaning. Implicit cost is the cost of using resources owned by the firm for which no actual payment is made, also called imputed cost. Points. 1. Non-cash cost. No direct payment is involved. 2. Opportunity cost. Refers to income foregone by using own resources. 3. Examples. Owner's salary, interest on own capital, rent of own building. 4. Included in economic cost. Considered in overall cost calculation. 5. Ignored in accounting cost, not recorded in books. 6. Decision making. Helps in evaluating true profitability. 7. Long-run relevance. Important for investment decisions. 8. Comparison differs from explicit costs which involve cash outflow. Conclusion. Implicit costs show hidden sacrifices of using own resources and must be considered to know the real profitability of a business. Number 6. Production function, meaning production function expresses the relationship between inputs, factors of production, and output of goods or services. Points. 1. Mathematical expression Q.Paper. 2. Input-output relation shows how inputs convert to output. 3. Short run and long run varies depending on fixed or variable inputs. 4. Efficiency measurement assesses productivity of resources. Law of variable proportions explains output changes with input variation. 6. Isoquants, graphical representation of combinations of inputs. 7. Technological change, production function shifts with better methods. 8. Business decisions, guides in planning resource allocation. Conclusion. The production function is essential for producers to know how resources affect output and to achieve efficiency in production. Opportunity cost, meaning opportunity cost is the value of the next best alternative foregone when a choice is made to use resources for a specific purpose. Points. 1. Scarcity principle arises due to limited resources. 2. Choice making. Every decision involves giving up something. 3. Example. Using land for farming means losing its rent from factory use. 4. Invisible cost. Not always recorded but very real. 5. Economic cost. Forms the basis of true cost analysis. 6. Guides resource allocation, ensures efficient use of scarce resources. 7. Personal decisions, applies to time and money choices of individuals. 8. National level, relevant in government project planning. Conclusion. Opportunity cost helps in rational decision-making by highlighting the value of alternatives sacrificed in every choice. 8. Cardinal utility meaning. Cardinal utility theory assumes that utility satisfaction derived from consumption can be measured in numbers or units called utils. Points. 1. Quantitative measurement. Utility can be assigned numbers. 2. Total utility. Sum of satisfaction from all units consumed. 3. Marginal utility. Extra satisfaction from one more unit. 4. Law of diminishing marginal utility. Utility decreases as consumption increases. 5. Consumer equilibrium. Achieved when MU equals price. 6. Helps in demand analysis, explains consumer choice and demand curve. 7. Simplifies calculation, easier to measure compared to ordinal approach. 8. Criticism. In reality, utility cannot be measured exactly. Conclusion. Cardinal utility provides a simple way to study consumer behavior, though modern economics prefers ordinal analysis for more accuracy. Paper, Faculty of Commerce, Bcom, CBCS V Semester Examination. December 2023 Business Economics, Generic Elective, Q.Paper, Common Paper for General Computer Applications, Advertising, Business Analytics, Foreign Trade and Tax Procedure courses. Time, 3 hours, max marks, 80. Part A, 5 to 4, 20 marks, short answer type. Note, answer any 5 questions. 1. Price theory. 2. Elasticity of demand. 3. Law of supply. 4. Production function. 5. Long-run cost. 6. Isoquant. 7. Market equilibrium. 8. Returns to scale. Part B, 12, 60 marks, essay answer type. Note, answer all the questions. 9A. Define business economics. Explain the nature and scope of business economics. Or B. Define the term utility. Explain the law of diminishing marginal utility with a table and diagram. 10A. State the law of demand with its exceptions. Or B. What is price elasticity of demand? What are the types of price elasticities of demand? 11A. What is consumer surplus? Explain how it is measured. Or B. What is indifference curve? Explain the properties of indifference curves. 12A. Explain the 3 stages of law of variable proportions. Which stage is important for production? Or B. What are the internal and external economies of large-scale production? 13. A. Explain the various short-run cost curves. Explain the relationship between average cost and marginal cost. Or B. What is break-even chart? Explain how to find out the break-even point with the help of the chart. Now, short answer type. Number 1. Price theory. Meaning. Price theory explains how the price of goods and services is determined in the market through the interaction of demand and supply. Points. 1. Basis of economics. Central theme of microeconomics. 2. Demand and supply. Price determined by forces of demand and supply. 3. Consumer behavior. Studies willingness to pay for goods. 4. Producer decisions. Explains how producers fix prices. 5. Factor pricing. Determines wages, rent, interest, and profit. 6. Market structures. Applies to perfect competition, monopoly, etc. 7. Equilibrium price. Price where demand equals supply. 8. Policy use. Guides taxation and price control policies. Conclusion. Price theory is vital to understand market functioning and allocation of resources through price signals. Number 2. Elasticity of demand. Meaning. Elasticity of demand measures the degree of responsiveness of quantity demanded to a change in price, income, or other factors. Points. Price elasticity. Change in demand due to price change. 2. Income elasticity. Effect of income changes on demand. 3. Cross elasticity. Responsive demand to price change of related goods. 4 types. Elastic, inelastic, unitary elasticity. 5. Formula. Ed equals Lucenta QDP. 6. Importance to business. Helps in pricing decisions. 7. Government use. Taxation policies depend on elasticity. 8. Consumer behavior. Shows sensitivity of buyers to prices. Conclusion. Elasticity of demand is a key concept for producers and governments to make rational pricing and taxation decisions. 3. Law of supply. Meaning. The law of supply states that, other things being equal, the quantity supplied of a commodity increases when its price increases and decreases when its price falls. Points. 1. Direct relation. Price and supply move in the same direction. 2. Ceteris paribus. Assumes other factors remain constant. 3. Positive slope. Supply curve slopes upward. 4. Producer motivation. Higher prices encourage more supply. 5. Exceptions. Rare goods, future expectations, perishable goods. 6. Determinants. Cost of production, technology, government policies. 7. Short run versus long run. Supply response differs over time. 8. Equilibrium role. Works with demand to fix market price. Conclusion. The law of supply explains producer behavior and helps in understanding price determination in markets. 4. Production function. Meaning. Production function expresses the technical relationship between input factors, land, labor, capital, organization, and output. Points. 1. Mathematical form. Q equals FL KRO. 2. Short run. Some factors fixed, others variable. 3. Long run. All factors variable. 4. Efficiency indicator. Shows productivity of resources. 5. Law of variable proportions. Explains short run production. 6. Returns to scale. Explains long run output changes. 7. Isoquant map. Graphical representation of combinations. 8. Managerial relevance. Helps in planning resource allocation. Conclusion. The production function is a key tool in economics to understand how inputs combine to produce maximum output efficiently. Number 5. Long-run cost. Meaning. Long-run cost refers to the cost of production when all factors are variable and firms can change plant size and scale of operations. Points. 1. No fixed cost. All costs are variable in the long run. 2. Planning period. Firms can adjust production capacity. 3. LAC curve. Long-run average cost curve is U-shaped. 4. Envelope curve. LAC is tangent to SAC curves. 5. Economies of scale. Falling part of LAC. 6. Diseconomies of scale. Rising part of LAC. 7. Efficient scale. Minimum point of LAC shows optimal scale. 8. Decision making. Helps firms decide plant size and expansion. Conclusion. Long-run cost is essential for business planning as it guides decisions on plant capacity, scale, and efficiency. Number 6. Isoquant. Meaning. An isoquant is a curve showing all possible combinations of two inputs, labor and capital, that produce the same level of output. Points. 1. Equal output curve, like indifference curve, but for production. 2. Downward sloping, substitution between inputs possible. 3. Convex to origin, due to diminishing marginal rate of substitution. 4. No intersections, two isoquants never cross each other. 5. Higher isoquant represents higher output. 6. Isoquant map, family of isoquants showing output levels. 7. Producer equilibrium, achieved when isoquant touches isocost. 8. Practical use, helps in input choice and cost minimization. Conclusion. Isoquant analysis is useful for producers to choose the best input combination for achieving desired output at minimum cost. Number 7. Market equilibrium meaning. Market equilibrium is the situation where the quantity demanded equals the quantity supplied at a particular price. Points. 1. Equilibrium price, price where demand equals supply. 2. Equilibrium quantity, quantity bought and sold at equilibrium price. 3. Demand-supply interaction, both forces determine equilibrium. 4. Graphical point, intersection of demand and supply curves. 5. Stability, prices above or below equilibrium adjust automatically. 6. Shifts, demand or supply shifts lead to new equilibrium. 7. Market clearing, no surplus or shortage at equilibrium price. 8. Efficiency ensures optimal allocation of resources. Conclusion. Market equilibrium maintains balance between buyers and sellers, ensuring efficient distribution of goods in the economy. 8. Returns to scale. Meaning. Returns to scale refer to the change in output when all inputs are increased in the same proportion in the long run. Points. 1. Long-run concept. Applicable when all inputs are variable. 2. Increasing returns. Output increases more than proportionately. 3. Constant returns. Output increases in the same proportion. 4. Decreasing returns. Output increases less than proportionately. 5. Causes of increasing. Specialization, better technology, economies of scale. 6. Causes of decreasing. Management difficulties, inefficiency. 7. Graphical representation shown with isoquant analysis. 8. Business use guides long-run production and expansion. Conclusion. Returns to scale explain how output responds to proportional changes in inputs, helping firms plan large-scale production effectively. Question paper, Faculty of Commerce Bcom, CBCS, V Semester Examination November 2024, Business Economics, Paper, GE, Common Paper for all streams. Time, 3 hours, max marks 80. A, 5, 4, equal 20 marks, short answer type. Note, answer any 5 questions. 1. Ordinal utility, demand curve. 3. Consumer surplus. 4. Production function. 5. Explicit cost. 6. Microeconomics. 7. Opportunity cost. 8. ISO cost. Hat Part B, 5 by 12, 60 marks, essay answer type. Note, answer all the questions. 9A, define business economics. Explain the nature and scope of business economics. Or B, explain the law of equimarginal utility with the help of table and diagram. 10. A, explain the law of demand and its exceptions. Or B, what is meant by price elasticity of demand. Explain its kinds with curves. 11. What do you mean by supply? Explain the factors influencing the supply. Or B, explain the consumer equilibrium through indifference curve. 12A, explain the law of variable proportion. Or B, explain the internal and external economies of scale. 13A, explain the short-run total and average cost curves with the help of table and diagrams. Or B, what is break-even point? Explain the break-even chart. Short answer type. 1. Ordinal utility meaning. Ordinal utility is a concept which states that utility, satisfaction, cannot be measured in numbers but can be ranked in order of preference. Consumers arrange choices as first, second, third, etc. based on satisfaction. Points. 1. Ranking preference. Consumers give order of satisfaction, not numbers. 2. Relative satisfaction. Utility is known in terms of more or less. 3. Indifference curve. Graphical tool for explaining ordinal utility. 4. Rational behavior. Assumes consumers make logical choices. 5. Consistency. Preferences are consistent and transitive. 6. No measurement. Unlike cardinal utility, no utils are used. 7. Realistic approach. More practical, as utility cannot be measured exactly. 8. Modern acceptance. Widely accepted in modern economics. Conclusion. Ordinal utility provides a realistic and practical method of studying consumer behavior by ranking preferences instead of measuring satisfaction numerically. Number 2. Demand curve meaning. The demand curve is a graphical representation showing the relationship between the price of a commodity and the quantity demanded by consumers. Points. 1. Downward sloping shows inverse relation between price and demand. 2. X-axis and Y-axis, quantity on X-axis, price on Y-axis. 3. Law of demand, basis of the demand curve. 4. Movement on curve, caused by change in price. 5. Shift in curve, due to income, tastes, or other factors. 6. Market demand curve, sum of individual demand curves. 7. Elasticity. Steep or flat curve shows responsiveness to price. 8. Decision tool. Helps producers in pricing policy. Conclusion. The demand curve is an essential tool in economics to analyze consumer behavior, predict demand, and set prices effectively. Number 3. Consumer surplus meaning. Consumer surplus is the extra benefit consumers get when they pay less for a product than what they are actually willing to pay. Points 1. Willingness to pay. Consumers often value goods higher than the price. 2. Market price. Actual price is usually lower. 3. Surplus benefit. The difference is consumer surplus. 4. Example, if willing to pay 50 but pays 30, surplus is 20. 5. Welfare indicator shows consumer welfare in the market. 6. Graphical area. Area under demand curve and above price line. 7. Policy use helps in taxation and subsidy decisions. 8. Limitations. Hard to measure exact willingness to pay. Conclusion. Consumer surplus measures hidden benefits to consumers, making it useful in welfare economics and government policy making. Number 4. Production function. Meaning. A production function shows the technical relationship between inputs, like land, labor, capital, and output of goods or services. Points. 1. Expression Q equals FLKRO. 2. Input-output relation explains how factors combine to produce output. 3. Short-run function. Some factors fixed, some variable. 4. Long-run function. All factors are variable. 5. Efficiency indicator. Measures productivity of resources. 6. Law of variable proportions explains output changes in short run. 7. Isoquants. Graphical presentation of combinations of inputs. 8. Managerial use. Helps managers allocate resources efficiently. Conclusion. The production function is an important tool to understand the relationship between inputs and outputs, guiding firms towards efficiency and growth. Explicit cost. Meaning. Explicit cost refers to the actual money payments made by a firm to outsiders for using resources like wages, rent, and raw materials. Points. 1. Cash payments involves direct expenditure. 2. Examples. Wages, salaries, rent, taxes, electricity bills. 3. Recorded in accounts, appears in profit and loss statements. 4. Visible costs. Easy to identify and measure. 5. Short run and long run. Exist in both production periods. 6. Business decisions, useful for cost control and budgeting. 7. Difference from implicit cost, involves cash, unlike implicit cost. 8. Profit calculation, necessary to calculate accounting profit. Conclusion. Explicit cost is the most visible and measurable cost, essential for maintaining accounts and determining profits in any business. Number 6. Microeconomics. Meaning. Microeconomics is the branch of economics that studies individual economic units like households, firms, and markets rather than the whole economy. Points. 1. Individual focus. Deals with individual buyers and sellers. 2. Price determination. Explains how prices of goods are fixed. 3. Factor pricing. Studies wages, rent, interest, and profits. 4. Consumer behavior. Analyzes demand and utility theories. 5. Producer behavior. Studies cost, production, and supply decisions. 6. Market structures. Explains perfect competition, monopoly, etc. 7. Resource allocation. Helps in efficient use of limited resources. 8. Foundation of economics. Base for macroeconomic analysis. Conclusion. Microeconomics helps understand individual decision-making and market functioning, forming the foundation for business and policy decisions. 7. Opportunity cost. Meaning. Opportunity cost is the value of the next best alternative forgone when resources are used for a particular choice. Points. Scarcity concept arises due to limited resources. 2. Choice making. Every decision involves a sacrifice. 3. Example. Studying for exams instead of watching a movie. 4. Business use. Choosing one project means losing another. 5. Invisible cost. Not recorded in books but very important. 6. Guides. Decisions. Helps managers choose best alternatives. 7. Economic cost. Essential part of total economic cost. 8. Government use. Important in budget and policy making. Conclusion. Opportunity cost highlights the real cost of decisions and ensures rational allocation of resources at personal, business, and national levels. 8. ISO cost. Meaning. An ISO cost line shows all possible combinations of two inputs, like labor and capital, that a firm can purchase with a given budget. Points. Budget line represents firm's spending limit. 2. Labor and capital, commonly used to show factor inputs. 3. Straight line, ISO cost line, is downward sloping and straight. 4. Equation, C equal plus RK, C equals total cost, W equals wage, R equals rent. 5. Shifts in line, changes with increase or decrease in budget. 6. Parallel lines, multiple ISO costs possible with different costs. 7. Producer's equilibrium, achieved where ISO cost touches isoquant. 8. Decision making, helps firm decide optimum factor combination. Conclusion: ISO cost analysis is an important tool in production theory as it guides firms in choosing the best input mix within a given budget.